It's the day you retire. You've done everything right. You started saving in your 20s, you sacrificed vacations you wanted to take, you sat through decades of terrifying market swings without panicking and selling at the bottom, and now, finally, after all of that discipline, you cross the finish line at 65 with $500,000 sitting quietly in your accounts. And then, for some reason nobody ever warned you about, you don't touch it. Not because you can't afford to. Not because there's nothing left in the world you want. Something deep in your brain simply refuses to let that number go down, no matter how many times you tell yourself it's finally time to enjoy it. 20 years later, at 85 years old, you're still sitting on more than $440,000 of that same money, almost completely untouched, like a museum exhibit of your own working life, sealed behind glass. You spent barely a tenth of it in 2 full decades. And here's the part that should genuinely bother you. This isn't some rare personality quirk that only affects a few unusually cautious people. This happens to wealthy retirees so consistently and so predictably across income levels and geography and personality types that researchers eventually had to give the entire behavior an actual formal name. So what if the richest retirees you personally know are, quietly, some of the worst spenders alive on the planet right now? By the end of this video, you're going to understand exactly why having money and actually spending money turned out to be 2 almost completely unrelated skills. There's something economists have been quietly arguing about for years, something that sounds almost too strange to be real once you hear it stated plainly out loud. There is a specific, well-understood financial product that mathematically protects a retiree from ever running out of money for the rest of their life, and almost nobody who can comfortably afford it actually goes out and buys it. Economists gave this exact phenomenon a formal academic name decades ago, and once you understand what it actually is, you will start noticing traces of it everywhere in how wealthy people quietly handle their finances behind closed doors, far away from public view, in decisions that rarely ever make headlines. But that's really just the opening act of this story, because the deeper you dig into how the wealthy genuinely behave with their savings once nobody is watching, the stranger and the more oddly deliberate this pattern of doing nothing starts to look. Let's start with the raw numbers, because they are genuinely wild once you actually sit with them for a moment. Retirees who had $500,000 or more sitting in their accounts right before retirement had, on average, spent down only about 12% of that entire total 2 full decades later. 12%. Not 80. Not 50. 12. That means someone retiring at 65 with $500,000 in the bank is statistically very likely to still be sitting on well over $400,000 when they turn 85 years old, 2 full decades further into a life they were repeatedly told to go out and enjoy. You might naturally assume this is simply what happens when people start out with less money, that maybe smaller nest eggs get instinctively protected out of pure survival necessity, the way you might guard the very last slice of cake more carefully than an entire untouched one. Except the exact opposite pattern holds true just as strongly. Retirees who had under $200,000 only managed to spend down roughly a quarter of it after 18 full years of retirement. Even people who genuinely didn't have very much money to begin with barely touched what little they actually had, which strongly suggests this behavior was never really about the size of the pile in the first place. Now here's where things get genuinely counterintuitive, almost backwards from what common sense would predict. You would reasonably expect that people with a guaranteed paycheck for life, meaning pensioners, would logically be the ones spending the most freely of anyone because they literally cannot ever run out of that particular income stream no matter what happens in the markets. It shows up reliably every single month, rain or shine, recession or boom. So logically, out of every group of retirees studied, these are the people who should feel safest finally cutting loose and enjoying themselves. Instead, pensioners spend down the smallest percentage of their overall wealth of any retiree group studied anywhere. The people with the least rational reason in the entire retired population to hold back are somehow, mysteriously, the ones holding back the hardest, the tightest, and for the longest stretch of time. Part of this may simply be that pensioners tend to have accumulated more total wealth to begin with, so having a guaranteed income doesn't necessarily unlock a brand new willingness to spend so much as it just sits there quietly alongside everything else, slowly gathering dust in an untouched account. Either way, the tidy assumption that guaranteed income automatically equals confident spending completely collapses the moment you actually look at real, carefully measured behavior instead of theory. It turns out that having enough was never really the obstacle standing in the way. Something else, something far more psychological, was quietly doing the real work all along. So if it isn't a genuine lack of money, and it clearly isn't a lack of security either, then what exactly is going on underneath all of this quiet restraint? This is where the story stops being simple, boring frugality and starts becoming something far more strategic and honestly a lot more interesting. Because once you start digging into how these dollars actually behave over decades, you find layer after layer of quiet financial engineering hiding underneath what looks, from the outside, like nothing more than plain old caution. Economists have a specific name for one particular piece of this larger puzzle, the annuity puzzle, and the mathematics behind it is almost embarrassingly clean and elegant once you see it laid out. If you convert a meaningful portion of your savings into a guaranteed income stream for the rest of your natural life, what's technically called an annuity, you protect yourself completely from the one single thing every retiree fears most deep down inside: outliving your own money before you outlive your own life. Standard economic models practically scream at people to take this obvious deal. And yet, almost nobody voluntarily does it, even when they can clearly afford to, and even when the math is heavily stacked in their favor. For a long time, economists simply assumed this reluctance was pure, irrational fear, people clutching tightly to their savings out of raw anxiety rather than sound, calculated logic. But a newer body of research adds an important twist that genuinely changes the entire picture. Health shocks don't just shorten how long a person is statistically expected to live going forward. They also create sudden, unpredictable, and often extremely expensive cash needs at precisely the moment someone is least financially prepared to handle them. A major medical event doesn't politely wait for a convenient, well-planned moment inside your carefully built retirement spreadsheet. And if your money is permanently locked away inside a rigid annuity contract, you may find yourself without the flexibility you desperately need at exactly the worst possible moment of your life. What looks, from the outside, like irrational hoarding might actually turn out to be a remarkably reasonable, well-calibrated hedge against a category of risk that spreadsheets and standard retirement calculators simply fail to capture well. In other words, the retirees who refuse to lock their money away might not be making a mistake at all. They might quietly understand something the textbooks conveniently leave out. This exact same underlying instinct shows up again in a completely different financial tool, one that wealthy retirees have started using in a way that would have seemed almost unthinkable to their own parents a single generation ago: the reverse mortgage. For decades, reverse mortgages carried an enormous social stigma. They were widely seen as a desperate, humiliating last resort, something you only ever turn to once you genuinely run out of every other realistic option available. That old reputation is quietly dying out among people who actually have substantial real assets standing behind them. Financial advisors are increasingly setting up a reverse mortgage credit line very early, often years or even decades before retirement ever becomes financially difficult, specifically so that it simply sits there, completely unused, functioning as a kind of standing insurance policy in the background. If it's never actually needed, wonderful, no real harm done, you paid essentially nothing extra along the way for that quiet peace of mind. If it genuinely is needed someday down the road, it's already fully in place and ready to activate instantly, with no desperate scrambling required under pressure. And the actual numbers behind this specific strategy are genuinely startling once you actually see them laid out side by side. Research shows that setting up this exact credit line early, long before any real financial emergency ever hits, produces dramatically better outcomes across a full 30-year retirement horizon compared to waiting until things get genuinely desperate and applying only under intense pressure. We're talking about portfolio survival rates that can run as much as 85% higher, purely and simply because the buffer existed early rather than arriving too late to matter. The wealthy aren't quietly avoiding debt here out of some abstract moral principle about owing nothing to anyone. They're deliberately prepositioning it, years or decades in advance, as a form of insurance they fully expect and even genuinely hope to never actually have to use, which is, in its own strange and roundabout way, just another elegant, quiet form of buying absolutely nothing at all. It sits there in the background for years, sometimes decades, doing absolutely nothing visible. And that invisibility is precisely the point. There's a version of this exact same instinct hiding directly inside the tax code itself, and it might honestly be the cleverest move of the entire bunch we've covered so far. If you're over 70 and a half years old and you happen to own a traditional IRA, there's a specific legal mechanism called a qualified charitable distribution that lets you send money directly out of that account straight to a registered, qualifying charity of your choosing. That distribution still fully counts toward your required minimum withdrawal for the year, fully satisfying the strict rule the government forces on every single IRA holder. But critically, it never once touches your tax return as reportable taxable income. Not partially, and not through some clever technicality buried deep in fine print somewhere. It simply never counts. Full stop, end of story. It is, functionally speaking, spending very real money that, from the government's own official perspective, never technically passed through your hands at all. A version of pure generosity that looks, on paper, exactly like buying absolutely nothing whatsoever. But if there's one single move that genuinely deserves to be crowned the best possible purchase a retiree can ever make, it isn't a financial product at all, and it doesn't come from a bank, an insurance company, or a financial advisor's glossy brochure. It's simply, quietly, a decision to wait. Delaying Social Security benefits all the way until age 70 is mathematically equivalent to purchasing the single best inflation-protected annuity available anywhere on the entire open market today, and almost nobody ever frames it that way in ordinary conversation. Researchers have actually run these exact numbers carefully, and the implied payout rate you effectively earn by patiently delaying all the way to 70 comes out to somewhere around 9.5% annually, compounding in your favor. Now compare that number directly to the very best commercial annuities currently available out there on the open market, which typically land around 8% for men, and drop even further to under 6% for couples buying jointly together. Delaying isn't just merely competitive with the best the private market has to offer. It comfortably and decisively beats it outright. And it manages to do so without a single dollar of the markup that every commercial annuity has to quietly build in to cover marketing costs, management fees, and healthy profit margins baked directly into the product from day one. The single best financial purchase available to nearly every retiree in the entire country is one made entirely by doing absolutely nothing at all, patiently, quietly, for 8 consecutive years in a row. So why does this exact same pattern hold so consistently across pensioners, across the genuinely wealthy, across ordinary people who have every rational, mathematical, well-documented reason in the world to spend freely and confidently? Because underneath all of it isn't really discipline in the way we usually think about and praise that particular word. It's fear, plain and simple, and it turns out to be a very specific, very measurable, very deeply human kind of fear. One landmark study found that 64% of Americans worry more about running out of money during retirement than they worry about dying itself. Read that again, slowly, and let it sink in properly. More afraid of running out of money than of death. That single statistic quietly reframes literally everything you've heard so far across this entire video. This isn't frugality being worn proudly as some noble, admirable, personal virtue. It's a specific, measurable, deeply wired form of anxiety that somehow manages to outrank mortality itself inside the average retiree's mind. And it's very likely the real hidden engine quietly driving all of this consistent restraint we keep seeing in the data decade after decade across completely different income brackets, professions, and life stories. There's also something happening on a purely biological level here that absolutely nobody consciously chose or deliberately designed on purpose. Researchers commonly break retirement down into 3 loose, informal phases, often nicknamed the go-go years, the slow-go years, and finally, inevitably, the no-go years. You might reasonably expect people to spend more freely as they get older, to finally squeeze the absolute maximum out of the limited time they genuinely have left on this earth. Instead, actual measured spending among retired households declines steadily, year after year after year, not because anyone consciously decided to tighten their belt out of some abstract sense of principle, but simply because ordinary human wants and physical needs naturally shrink as people age further into their 80s and 90s. Buying nothing late in life may not truly be strategic caution at all, in the end. It may simply be quiet, patient biology doing its own thing, entirely on its own private schedule. And this underlying instinct is so genuinely powerful and persistent that financial planners have had to invent clever workarounds specifically designed to fight directly against it. One technique some advisors now actively use with their clients, instead of treating a lifetime retirement account as something fragile that must be rigidly protected at absolutely all costs, they deliberately set up an automatic monthly transfer, essentially casual fund money, moving straight into the client's everyday checking account like clockwork every single month. Why does this small, almost silly-sounding trick even work so well? Because most people spent 30 or 40 long years of their working life reliably receiving a regular paycheck, and it turns out to be dramatically easier, psychologically speaking, to spend money that simply shows up the way a familiar salary always used to, than to consciously and deliberately withdraw from a nest egg they spent an entire lifetime carefully building and protecting. Even wealthy, financially sophisticated retirees very often need their own hard-earned money quietly reframed as ordinary income before they'll genuinely let themselves use it without guilt. It's a small psychological trick, almost embarrassingly simple, and yet it works precisely because the habit of receiving a paycheck runs far deeper than any spreadsheet ever could. Which finally brings us to the very last piece of this entire puzzle, the one that quietly ties everything together and reveals something most families never see coming until it has already happened to them. When wealthy retirees hold on to appreciated assets, meaning stocks, real estate, and investments that have grown enormously in value over many decades, instead of spending them down or selling them off during their own lifetime, and then pass away while still holding those exact same assets, their heirs receive them at what's formerly called a stepped-up cost basis. In plain, ordinary language, decades of accumulated capital gains simply vanish, instantly and completely, for tax purposes the moment ownership transfers. The growth that would have triggered a genuinely significant tax bill if sold during the retiree's own lifetime disappears entirely the very moment it passes over to the next generation. What looks entirely from the outside, like simple caution or old-fashioned thriftiness in someone's final years, can actually turn out to be the final, single most lucrative move of an entire lifelong financial strategy, executed almost invisibly. The less a wealthy retiree ultimately spends or sells while they're still alive, the more real, substantial wealth quietly slips forward to their children and grandchildren, completely untaxed and fully intact. It's the single, quietest, least visible transfer of wealth imaginable, and it works precisely because nothing about it ever looks like a strategy from the outside. Suddenly, every single piece we've covered earlier in this video snaps sharply into focus, like scattered pieces of one much larger picture finally coming together at once. The annuity puzzle, the reverse mortgage credit line that nobody actually touches, year after quiet year. The charitable distribution that mysteriously never counts as taxable income on any tax return. The quiet, patient decision to simply wait 8 full years for a permanently larger Social Security check every single month. None of these were ever really isolated little habits or unrelated personal quirks. They're all fragments of one much larger, mostly unconscious, overarching strategy, playing out in extreme slow motion across decades. Convert spending into safety, convert that safety into a lasting family legacy, and then quietly let the tax code itself finish the job on your behalf. So think back one final time to that retiree standing at 65, sitting on $500,000, still holding on to more than $400,000 of it a full 20 years later at 85. It was never really about simply being unable to spend the money they'd worked so hard to save. It was never really about fear alone, or pure discipline alone, or clever tax strategy operating alone in isolation. It was all of it happening together at once, quietly reinforcing and amplifying each other, mostly without anyone ever consciously sitting down at a kitchen table to design it that deliberately from the start. So the next time you happen to see someone who genuinely seems to have everything in the world and still somehow buys almost nothing at all, don't automatically assume it's simply because they can't bring themselves to enjoy their own hard-earned money. Ask yourself instead what exactly they've already quietly bought in its place all along: security, flexibility, a meaningful legacy that costs the next generation absolutely nothing in taxes. Sometimes the single most expensive purchase a person ever makes across their entire life is the one that never actually shows up anywhere as a visible transaction at all. No receipt, no invoice, no line item on any bank statement. Just decades of quiet decisions stacked one on top of another until one day the whole strategy finally reveals itself all at once to whoever inherits it.